Hello, welcome back to Mr. Money TV live on Thursday night. This is Peter.
Yo, what's up, everybody? Good evening. This is Frankie from FAQ Show.
All right, hello. Now, if you can hear us loud and clear, maybe what you can do is that you can type 1 in the comment. Frankie,
Hey.
let's start the week with start the session today with a simple question, right? Yeah. How has your week been?
This whole week, I'm quite busy looking at the market simply because suddenly everything seems to be coming down. It has caught some investors by surprise also lah. Like suddenly, wow, why suddenly drop so much, right? Everything.
Yeah. I think a lot of people were like, oh, what on earth? And I tell you what was one thing interesting, Today, I think it was today or the day before, I can't remember. But Jensen Huang made a statement about quantum computing.
Oh, the new nano thing, right?
He talked about quantum computing. He said that he think that you need to give it at least 20 years before you can really see real life effect. Immediately, all the quantum stocks
Plunge.
plunge, man. It went down by 40%. Crazy. Walao eh.
Yeah. So these days, all the big shots, when they want to talk, they need to be careful a little bit.
Hey,
Whatever they say is going to affect the whole market.
I realize US people, when you're a big shot already, when you talk, you can move the market, man. This is what we call when you can make money with your mouth. People say we both 靠口吃饭 so we talk to make money. I think they want really another level. Different level of 靠口吃饭, right? The whole world can make money together or lose money together when they talk. Yeah. So jokes aside, right? I think what I want to talk about today, or what we want to talk about today, is actually why did the market crash? And today we're just discussing about this topic.
Yep.
And do you realize that actually the market quite interesting? What do I mean by that, right? It's like every year about this time, also you kind of see similar thing, just in different quantum, right? Over the years, I came to learn that the market tend to repeat itself, just in a slightly different pattern. Now, I recall you mentioned before to me last time that every market has its own DNA, right? Yeah. Maybe you want to explain that a little bit. What do you mean by every market has its own DNA? And to a certain extent, maybe relate it back as well to how the calendar brings out the DNA sometimes.
Okay. Let me use the Malaysia market to explain, because everyone is from Malaysia, so it's easier to understand. So obviously Malaysia stock market is Bursa Malaysia lor. And to find out what is the DNA, first we need to understand who are the players in the market. In Malaysia, the biggest chunk of the trading volume that you see every day, more than half of it is contributed by institutional institutional investors. What are institutional shareholders, right? There are people like your EPF, your ASB, and then your insurance funds, your unit trust funds, and all these fund managers. So they are generally known as institutional shareholders, and almost 40 to 50% of the trades is actually contributed by this player. So whatever they do carries a lot of weight in terms of how the market is going to move. Is it going to go up? Is it going to go down? Then the next bigger chunk of it is actually retailers. Like us, right? You and me. So that makes up the second biggest group of the entire trading volume. And the smallest part of it is foreign investors. Now, the interesting here is that sometimes how they identify who are foreign investors is also very interesting. How Bursa define foreign investors is a direct, if let's say the order comes from overseas into Malaysia, that's considered as foreign trades. But there's also one kind of foreign trade that I don't think is being captured in that essence, is that what if the foreign fund or the foreign investors call local brokers to place the order? Then it will be recorded as a local trade. So sometimes people would want to go and go down the rabbit hole and really go and dig out and see, okay, of what percentage is actually foreign? Because foreign trading is, they don't care one, right? If I want to sell means I will go to hood, right? If I want to buy, it's also hood, right? So they carry a lot of volatility factors in Malaysia trade. So that's the DNA of the Malaysian market. If you want to know whether the market is going to go up or go down, I think the best way is to go and have a drink with all these institutional investors and have a feel of what they think about the market, right? That will give you a very good sense of where it is going to head to. Now, just now you mentioned about calendar. Okay, before we talk about calendar, I think all of us also somewhat have insurance and investment linked products, right? Unit trust and all that. So when you buy unit trust funds, for example, every year end or every quarter, or no matter what kind is their reporting structure may be, they will have to come out a report to show people like us what is the performance, right? So very often they want to show good results, no? But sometimes, when you trade along with the market, your performance might not be too good or don't really hit the expectation that they want to show. Then what happens is that because they're institutional investors and they control the large chunk of the trading volume, what they can do is this thing called window dressing. Now, window dressing is not just something for Malaysian, it's the whole global financial industry also do window dressing one. Now, what happened is that, let's say, for example, today, KLCI index is 1,006.
Maybe before that, can you explain to us what's the analogy of window dressing? What does it mean?
Okay, right. So when you have a house, for people outside to look in, they cannot see anything but the square box, right? So how do you tell people outside that your house is very beautiful? Because takkan you go and invite people to come to your house and see, right? So what you can do is this thing called window dressing. You dress up the window to look very beautiful so that it gives the impression for the outside people to say, wow, maybe inside is also very beautiful. So that's called window dressing. So window dressing means once the person see it, okay, very nice, then he chow already, right? You can take it down.
Right.
So you take down the window dressing.
Yeah.
So in the investment context, it is also the same. So very often when it comes to reporting season to their unit holders like us, what they will do is window dressing. And how do they do it? So let's say, for example, today index is 1,006 points. And perhaps their KPI is that, I need to achieve, let's give an exorbitant example, right? I need to achieve 10% growth. 10% outperformance compared to the index 1,006. So what do? Because they control a lot of funds, right? What they will do is they will find the stocks that can move the index. Then on the day of the reporting that they need to close the book, they will pump up the market to show that it has a very good performance. Then once the book is closed, because they're going to use that pump up number to do the reporting, then suddenly the performance look very good. Right? Okay, fantastic. The following day, right after that, because they have done their reporting, they've done the job already, right? Then the whole market is going to normalize. It would sometimes it's immediately, sometimes it takes a few days for the window dressing to undress itself. Yeah, so that is one of the things that usually happen during this period of time. So some people who want to play specifically on this window dressing phenomenon, right, is that they will roughly gauge when the window dressing period will happen. Then they will buy up the shares first. When window dressing happen, because they're going to pump up the shares, right, then they wait there to sell the shares. So they earn the gap. Yeah, but this is highly technical and stuff, so we don't want to go inside too much.
Yeah. So you try to think about it, right? It's as good as, let's say, your appraisal period is near, so you try to do something to make your appraisal look good during that period of time.
Correct.
Yeah, but actually, your normalized effort may not be exactly there. Yeah. So I think that is generally what happened. Yeah, when we talk about it. But I guess on the other hand, also every year about this period is about that. Like
year end, usually.
Year end, and whenever it's about time to report their quarterly thing, also once in a while. Yeah, but I think the most power one usually is during this period. So then the question is this, right? We are still facing a few things moving ahead. There's a lot of talks about whether Fed will reduce the rates because the market looks rather strong at this point. And I guess it's also partially because of that many people kind of like hold off their investment at this point or they're waiting to see what's going to happen, right? Because previously the market was very hot. Everyone was expecting a lot of, it's got to be a great reduction in interest. But it looks like now Jerome Powell is really standing strong there, right? And say, hey, no, man, I'm not going to do that, right? While on the other hand, there's also another force that's going on, which is on the 20th, if I'm not wrong, is the inauguration of President Trump. And many people are expecting some exciting news. For one, they are expecting him to announce a crypto reserve
Yep.
of 1 million units that they're gonna buy or something like that, lah. Right? Now, there are a few things that's going on there, but my bet is I don't think he'll announce that. Because if he announce it, everyone will rush to it, right?
They will start pricing in already, right?
Correct. And then you will buy at a very expensive price.
Yep.
So my personal thought is he will just, probably just end up saying some good things, but hint, but not really hint. That kind of thing lah. Like you don't really get it, and then suddenly one day he may just say that, oh, actually we do have significant reserve. That kind of story lah.
Yep.
That's why I think it will likely end up happening.
Yep.
But either way, I would say that I'll expect the market to be a little bit of a sideways in the beginning of the year, but I think the action will start kicking in the next 2 months or so.
Yeah, this year is very special because we have the new president in the US, and we kind of know, but at the same time, we don't really know what the new president wants to do, right? Like, I think last week or a few weeks ago, you did mention that somewhat Donald Trump seems to be okay with China and perhaps not be too harsh on tariff hike. But then suddenly, few days ago, he turned again, right? He said, "Oh no, I'm going to hit Denmark and Canada with a high tariff." Then suddenly, this whole narrative comes back again. Oh no, if he's really going to do it, it's going to make things even more expensive. Then that may contribute to inflation. Inflation means chances are the Fed also cannot lower down the interest rate. So that whole story comes back again. And that becomes one of the key reasons why the market is behaving like what it is now, because a lot of expectation is still on the Fed lowering down interest rate. And when we talk about interest rate, we cannot forget that it's always to adjust the inflation number. So if you are still not convinced that inflation is the big theme and the big factor that influence the market, right? I think this whole week itself is a good case study to prove that it is still interest rate and inflation that drives the market today.
Oh yeah, that's still the basic market principles, right?
Correct.
Yeah. So I think those are all part of the things that we really want to pay attention to now. I think there are a few things we are just gonna end up repeating ourselves to a certain extent, which is inflation, interest rate is one of the things that you really want to look at. And because ASEAN is going to be happening, right? I think there'll be certain questions that they'll be asking on how to position ourselves as well. I guess I'm kind of looking forward to that central bank meeting. Apparently, they'll have central bank governors all to come together to actually have a meeting to discuss some monetary policies and stuff like that one. So hopefully we get some interesting news then. I think there is also Bank Negara will be doing some communication soon on monetary policies. I think we're invited.
Oh, really?
Oh, yeah, we're invited.
Oh.
Let me see whether we are RSVP already or not.
Okay.
yeah. Now that I say that, remember, we're actually invited.
Okay.
Yeah. Okay. I guess another thing, still AI is still going to be one of the things that's going to drive the market in terms of technology. I actually did some digging on quantum computing. I can't help but to think that it is very amazing. But yes, there's still question about how will it give real life applications that is usable and impact our daily lives. Although it seems rather far-fetched at this point, but maybe because I personally and you also lived through the days where internet used to be just the internet and today it is everything in our lives. A lot of the things that we used to think is impossible today, we are living it. I think I'm quite open to the idea that in the next 10 years, there could be another revolutionary change, right? So I recently was looking at NVIDIA's presentation talking about future of AI. They talked about agentic AI, means moving on ahead, what we are looking at is I think we talked about this also a little bit a few episodes back where we said that AI is just commoditized, right? It's just knowledge. The question is that how do you create a service on top of this, and think of it in this way where the AI becomes your agent, where it runs a business for you in that sense, right? So that is the whole idea behind agentic AI lah. That's what they mean lah. So I think those are some of the things that will really, really, really come in place, that we really need to ask ourselves what are the opportunity moving ahead.
Yeah, maybe next time all this AI can help us to predict what is the market direction. All right.
Yeah,
That would be something interesting.
that's right. Yeah. So have you ever tried getting ChatGPT to tell you what they think the stock market will be doing?
I tried to use it on Bitcoin before. But it is as good as Feng Shui Master tell you your next year gonna be good. You should face this direction and whatnot lah. So it's up to you to believe, to disbelieve.
Right.
Sometimes it's correct, sometimes it's wrong. So it is not really reliable to ask ChatGPT to help you to predict the market.
No, another thing that I want to ask you is this, right? Following up from our last week's conversation, you have been using this UFO method to do some regular day trading or week trading, right?
Yes.
You're 1 week in by now or 2 weeks in by now?
2 weeks in by now.
2 weeks in by now. How's the result so far? How many trades have you made, and what's the result like?
All right. The number of trades I made, I cannot remember already. It is many.
Many?
Many.
Many is it everyday one or everyday two?
Every day a few lah.
Everyday a few?
Yeah,
Wow, damn active way.
Every day a few trades.
So you really want to test it lah?
Yeah, I really want to test it. So this is my result. Okay, I share with you guys. So my conclusion on the UFO is that when the market is stable, it is very predictable, it is very accurate. But in the past few days, it has gone haywire. So I think the market needs to settle down, and then the whole formula needs to recalibrate. Then only it will go back to the accuracy again. So when everything starts to drop, right, that day I lost a bit of money.
But overall, after so many trades, what's the percentage of wins like?
Okay, so let's don't count the monetary win or loss. We just count by the accuracy of the number of trades that I went in and out, right? I've done multiple trades. I cannot remember how many trades I've done, but it is so little mistakes that I know how many mistakes was made.
Okay.
The answer is only 2.
Oh, only 2 lost trades?
Only 2 lost trades.
Including the one when the market
Including the one that went with haywire. So haywire, I know I lost money with it, right? So I stopped lor. So I don't touch it anymore. So right now I got no trades. So these 2 days I got no trades.
Wow. So it means that as long number one is a clear trend, then you can make money.
No, as long as the market is stable, don't be like the past few days like that.
Not sudden news kind of. It has to be clear trend.
Correct.
Clear trend.
Correct.
Right, we know that is a overall bullish or something like that, or overall sideways a bit. As long as it's not too up and down suddenly out of the blue. Right, okay. Then it's fine. And have you made more than 10 trades?
More. Oh, by 2-3 days, I already more than 10 trades already.
So if you were to not adjust the risk that you are risking for your capital risk, you are just using the same amount. It means that if you are gonna aim to make $1 per trade, you would have made money lah overall.
Correct.
So you made money lah.
Correct.
Overall.
Correct.
It's just lose 2 trade lah.
Lose 2 trade, but the last trade was a bit more xiong lah because the drop was very big lah. So I
didn't put stop loss, is it?
I didn't put stop loss. So when I wake up, I was like, oh no, it's like
You
lost so much.
already,
faster cut. Yeah.
But you are supposed to put stop loss, right?
I'm supposed to put.
Then why you never put stop loss?
I don't know lah, because I didn't expect it to drop by so much ma. So that's something that I'm not disciplined enough.
So it's more of a human error. Oh, interesting.
Which is a mistake that I learned also, because I put TP target, but I never put stop loss. So I limit my upside, but I never cover my downside. So that's the reason why the past few days that loss was a little bit bigger. But thanks to the past few trades that I made, that all made money. So I'm still okay lah for now.
I see. Okay. Yeah.
But coming back to the market, right? There's one very interesting observation when all things started to come down. Is on the bond yield in the US. So bond yield started to climb, right? As we all know. I think for the past 4 days, it has been just going up and up and up. And we all know that Bond yield increase means the bond price has dropped, which also means fund managers or investors have been selling bonds, right? Now, we all know that bond investment is one of the safest type of investment because government bonds, who is going to expect the government is going to collapse? And someone we're talking about the US, right? The world #1 economy. But the true fact is that people are taking money off the bond market, which also means if investors are fearful of the most safest investment, then it may signal something. And that has trickled down to stocks, has trickled down to crypto and all the other assets. And that is the reason why everything has been coming down recently. Which is quite scary because if bond yield continues to go up, then I think this downtrend is going to last for a while.
Actually, sometimes I'm wondering is the bull market, okay, this one is being a bit more pessimistic and also being more questioning that kind of mode. Do you think that sometimes this bull market is kind of like because people want it, so people are doing whatever they can to make sure that it happens?
Yeah, it's called...
rather than it's really fundamentally supported.
It's called price to perfection. Yeah, everything is priced to perfection. Everybody thinks that, NVIDIA is going to be perfect. Meta is going to be perfect, right? Whatever things that you invest in is going to be perfect. So everyone just price for their perfection. They never think about risk. They never think about whatever things. So you just need a very small trigger to bring everything down.
Correct.
Yeah.
It's quite scary, because you think about it, right? The way that the market is working right now, why is it that the whole S&P is pretty much driven by the big 7 companies? You're actually very heavily skewed to the top 10 companies, I'll put it this way. Yeah, it's so heavily skewed, right?
Yeah.
That to a certain extent, S&P is not even diversified as we expect.
Correct. But there's no point for you to diversify too much because if you buy other stocks, you're going to be underperformed.
Okay.
Because the movement is all in the big companies.
And so then it displays a behavior of fund managers to a certain extent for me. I think they are all facing a very big issue. While deep down they know that fundamentally the economy is not as strong as it's supposed to be, or it looks like it's supposed to be, they have a pool of money that they have to invest. Whether they like it or not, they cannot keep it in cash. And because of the unit trust structures, the fund structures, there's always mandate. And the mandate says that right now, let's say you're an equity fund, you have to invest in equity. You can't be holding mostly bond. You can't be holding mostly cash.
Correct.
In fact, fun fact, for those of you who do not know, actually many fund managers who perform very well generally challenge the mandate a bit.
Fund managers will try to keep their mandate as loose as possible.
Correct. Because it allows them flexibility. So to put it that way is that, let's say by mandate, it says they are supposed to keep 80% into stock. Sometimes they will delay that readjustment just because they know that if they follow that, then it's not going to be very good, right? Now, but my point is this, right? My point is that, but if they were to follow that, what will happen is that it will go against many of their mandates, so they are forced to go with that. But if right now they were to invest in the non-top companies, there is a problem. Because when they invest in the non-top companies, what happens is that you are starting to trigger a market down in that sense, right? Because it means that people are going to start pulling capital from elsewhere to invest in smaller companies. But there are so many smaller companies, and the smaller company that your fund invests in and my fund invests in is very different. And so what happens is that if my fund lose money, I need to be answerable.
Yep.
Right? But at least if I invest in the big company and lose money, everyone lose money, You get what I mean?
Yeah.
So it becomes this
vicious cycle.
Correct, right? Like you say, right? It's like you say, price to perfection is a nice word to put it. Because at least if I put it there, it's reasonable, it's understandable. There's no one that can blame me. And number 2, it is going up. If I were to not follow that trend, also I get tikam anyway. I follow that trend, also I get tikam. I don't follow that trend, I get tikam. Actually, the truth is, might as well I keep my job . And to keep my job means that I at least keep the numbers up . And so what happens is that everyone is just trying to chase for that same purpose and thing, because they know that if the market were to reset, it means out of the pool of 100 fund managers or 1,000 fund managers, some are going to get into trouble. Must as well all of us bear the same risk. We all price it to perfection. At least we can say it's a group thing. You know, it's a group thing, right? Like group THINK, and it's a group thing, THING as well, right?
Group thing and group thing.
You get what I mean, right?
Yeah.
You get what I mean? It's kind of like self-preservation that you do not even need to say it out. Yeah, I think if you say it to fund managers, they're going to flip. They're going to be,
Yep.
nah, there. But the truth is, I think it's a bit of a...
Yeah, so to help you guys to understand the unit trust world, right? Generally, unit trust got two kinds of funds. One is called income fund. One is called growth fund. I think without going into explanation, you all already roughly can gauge what kind of mandate an income fund would have and what kind of mandate a growth fund will have, right? So income fund, like the name suggests, the main focus is just to generate recurring income, right? That's why it's called an income fund. And because the mandate is to continuously generating a sustainable recurring income to the unit holders, their mandate is more skewed towards like what Peter mentioned just now. As long as I can keep my job, the fund is safe, the money is protected, I am benchmarked very well against the whatever KLCI or whatever, then it's good. It's safe. Now, the other kind, the growth fund is slightly more aggressive, as the name suggests, because it is looking for growth. So this kind of mandate tend to have looser mandate, and it can hold more cash, and it gives the fund manager more flexibility to move around. And the stocks that they invest in typically has more small to mid cap stocks. They don't go too much on the KLCI top 30, that kind of things, because top 30 KLCI cannot give you that 20-30% return per year one. You must go like really, really small kind of stocks to invest in. So that's generally the two kinds of unit trusts in the market. So next time, if you all want to meet your agent, you want to pick the fund to invest, so perhaps you can ask your agent this question. So the fund that you're asking me to buy, what kind of fund is it? Is it an income fund? Is it a growth fund? And if it is a hybrid, then what is the composition like? You know, stuff like that. So it will make you guys look smarter also lah when you all talk to your agents.
Yeah. So learn how to ask the right questions is one way to invest in unit trust funds. Now, someone in the question here asked this about yield curve inversion, right? Yeah, yield curve inversion.
Already inverted very long
quite
already.
some time ago. So it's been inverted quite some time ago. But for those of you who want to know what is it, basically an inverse yield curve means that a long-term bonds rate
has
lower.
more yield. Has more yield. Okay, put it this way.
No, has lower yield. Wait.
Come, let me explain. Come. Let me take the question.
No, long-term interest has a lower interest rate, and then short-term rate has the highest interest rate. That's an inverse bond curve. Inverse, ma?
Okay, never mind. You go on first, then later I will chip in.
So, you think about it, right? The logic is very simple. Okay, what is a bond curve? Okay, if I'm wrong, then you say, but I'm pretty sure I'm not wrong, lah.
Right.
Yeah, because I'm reading the facts when I'm saying it.
Okay.
So now the idea is this: in the yield curve, right? How it works is that, let's say today lah, you loan bond means I loan money. If today I loan money in Frankie said I only want to pinjam for 2 days. What kind of interest rate should I charge Frankie? Is it high or low? Because it's only 2 days, it's low, right?
Correct.
Compared to if he tell me, he say, hey, I want to pinjam for 10 years. Hey, bro, 10 years, you know. You better give me a bit higher lah. That's the whole idea behind, right?
Yep.
So that's a normal expectation of a loan.
Yep.
But when it inverse, it means that when you borrow for a short period of time, let's say he said 2 days, I say 4%. Then he said 10 years. I say, 10 years. Chip lah. I give you 2%. Yeah, that's the idea. So it's out of normal behavior. What does it signal? Is me as an investor, right? It means I want to faster deploy my money into something safe for a long term. It means that I'm expecting market to be very bad for a very long time.
Yep.
Yeah.
It's correct.
Right?
So
correct,
I don't
right?
need. Yeah. So I don't need to re-explain.
Okay.
Yeah.
Now, So that was what happened. I think it was during COVID period. That was what happened. It means that the market was expecting a very bad recession. Now, subsequently, what happened was that market became very volatile, but we didn't go into a full-blown recession. Market is still quite propped up, like we were talking about just now and everything all. I think what happened was that last year, we start to see a reversal. It became longer term again. We are seeing a higher return, higher yield, and then the shorter term, we are seeing lower yield. So it means that the market now is expecting the economy to recover. That they are saying that, okay, it's likely not going to go into a recession, right? That's what it means. However, okay, so it's actually a good sign to put it this way, for those of you who are asking why is it. But, however, I want to say also this one thing. Yield curve is not a future prediction also. It's also a bit of a past behavior. You think about it, right? The reason it dropped is because people are responding to it already. Yeah.
Correct.
So it's pricing in things, right?
Correct.
That's the thing that you all want to beware about. Don't think that because of yield curve reversal means that things are going to be good. But when it reverses at such a big rate, it also kind of tells you that maybe everyone knows that it's going to be priced to perfection. So, well, either way, I don't think it's going to die that kind.
Yeah.
Maybe that's the idea.
So one way to explain my point earlier about the yield going up and then fund managers selling bonds and the kind of stuff, right? The other perspective can be that maybe the fund manager thinks that the Fed may not cut interest rate, but to the extreme is perhaps it may increase interest rate. Right? So if the Fed increase interest rate means that the new bonds that the US government is going to issue is going to carry a much better return.
Yep.
So as a fund manager, what would you want to do is to sell the existing bonds that you have today,
which has a lower return,
and wait for the new bonds to be issued, and then you buy the new one. So that is one of the explanation that the fund managers are selling bonds today, which result in the yield has gone up. That is the expectation.
Yeah, and that's why the market went down.
Correct. It's all about fear and sentiment and all that.
Yes, that's right. So that's why I think sometimes if we respond too much according to fear, what will happen is that you really don't know where to go.
Yeah.
Now, on the other hand, right, I think there's one thing that you have to understand, right? I think over the years, I also came to realize this one thing. How the institutions look at the market, right, will be very different from how a retail person respond. Now, why is it so? Because fundamentally, the quantum is different. Yeah. What do I mean by that, right? Let's talk about individual stock picking. Let's not talk about diversified ETF investment. Right? Today, if let's say, Frankie, you're going to invest, you're looking at 100,000 ringgit or 200,000 or 1 million ringgit. But how much can you buy?
Very little.
Right? Yeah. Versus a fund manager. That's a whole different thing. I can divide my portfolio up and say 30% will be used to hedge against this, 70% is to hedge against this. But for someone with only a million ringgit, right, your portfolio, in order to make a meaningful return, very often is going to be slightly more concentrated. Yeah. You're not going to buy 100 stocks. Yeah. You're likely going to be a bit more concentrated. You are likely going to be more decisive in terms of the strategy that you're going to pick. And so for those of you who wonder why some rich people still buy unit trust or ETF, is for that precise reason where they want diversification despite the fact that they have 2 million or 6 million or 10 million. Because I guess in the real stock market world, 5 to 10 million honestly is not a very big amount to do. I give you a perspective. Private mandate minimum you need 5 million already. Private mandate means you give a official fund manager and say, look, invest for me.
I don't want to follow your mandate. This is my mandate for you. You follow.
Yeah. It will be.
Yeah, those are called private mandate, and usually is a high net worth product.
And minimum is 5. And 5 also is like kind of like lion you a bit, that kind. And usually that so-called private mandate will end up be an attachment into something existing. Rather than the whole development of new strategy for you, right? Yeah. So the point I want to make is I think at the individual level, sometimes you just have to call your cards if you are an individual stock picker. Yeah. And that means that you will have to stick to it longer. So what do I mean by that, right? Now, fund managers need to do window dressing because they need to show report card. In fact, every quarter they will develop a fund fact sheet. That fund fact sheet need to show you something good lah, put it this way, right?
Yep.
Imagine every quarter when you read the report card is bad, then you also pick check already, true or not? So you also want to look good, man. Although you don't track real life, but you want to look good at the quarterly result, right? And so some of the decision that they have to make will have to follow that. A fund manager who doesn't want to follow that rule will need time to prove themselves that they have been able to call a good shot. Then you can trust them for the midterm jitters, right? Or the midterm volatility. But again, it's chicken and egg lah. You don't give me time to prove. How can I prove, right?
Yep.
Yeah. But as an individual investor, the good thing about it is that you got no such report to present. As long as you can tolerate with the risk appetite, you can say, I'm going to hold on to it till the day I die. True or not? And so, therefore, my personal opinion is, as an individual stock investor and as a retail investor, don't let all these noises affect your decision also, because you have to understand whatever we talk about, and when we talk about all the news, like Frankie just now say, oh, this means this means that, right? You must understand 9 out of 10 of all these finance paper are not written for retail guys. It is written for institutional investor for them to make that 1 year or 3 months decision. That makes sense, right?
Yep.
Yeah. Individual investors bulletin will be a very different thing altogether.
Yep. Correct.
Yeah. So that's something that I just want to highlight before we move on.
Now, institutional investors, while they may sound professional and all that, but my personal experience is I notice they tend to follow market sentiment even more than individual investors. Yeah. Because when the market is down in general, sometimes you have to follow. Because if you don't follow, then again, your boss will ask you, hey, why everybody sell already, you still hold the stock? You still want your job or not, right? So sometimes they have to follow.
Yeah. Are you willing to stick your neck out? You really
Correct.
believe in it? You better
Correct.
stick your neck out.
Correct. But as individual investors, you don't need to report to anybody, and you are still convinced that your investment makes sense, and perhaps this period might be a good time for you to average down, right? So it's a very different vibe lah.
That's right.
Between these two kinds.
Actually, I feel bad for fund managers suddenly, to a certain extent. I think when we are saying all these, it kind of hits their heart a little bit, right? But they won't say lah, obviously, right? Yeah. Because you think about it, right? No matter how good you are, how many times are you going to make the right decision?
Yep.
Out of 10 times, you'll probably make 2 or 3 bad mistakes, let's say, right? Or you didn't make the right call 2 times. People will not remember the 10 times that you made the good call, but people will remember the 2 times that you didn't make the good call, and you'll lose your job because of the 2 times, but you may not get a promotion for the 8 times that you made a good call.
Yep.
Yeah, and because they stick their neck out to say that, hey, my investor will appreciate me. You know what? By the time the fund factory go out, you are the first guy that's going to be blaming them.
Correct.
Right?
A fund where the performance is bad is the most stressful period for the fund managers, because the manager, the company will likely ask the fund manager to stand on the stage to face the client to answer those questions, man. Yeah, so they don't want one.
Correct, right? So you rather make it in an acceptable manner.
Right.
Oh, market.
Yeah.
That's the best answer.
Correct.
At least I can just say the market sentiment.
Yeah.
Better than I stick my neck out and then what am I going to get? Right? So sometimes I feel like that's a sad thing. That's why to a certain extent as well, I notice like what you say. I think if you really, really go to fund manager and ask them, what will you invest in? I think you have to get them drunk to talk.
Correct. You get them drunk, then they tell you different some of the stories.
That's why investment banker go out and have a drink, right? Yeah. So that's why you're not going to add in, really. You're just going to keep quiet.
Keep quiet.
Done. Now, anything else that you think we should highlight to our audience before we move on?
No, I think if you want the market to turn again, I think the whole headline needs to come up with a new catalyst. Give people a new hope that things are going to change. Then the price can go up. If not, I think the rebound or whatever, right, is just going to be temporary until we really see that new catalyst appear in the market.
No, I think there are a few things to actually look at. Will be definitely when Donald Trump takes the office lah. Yeah.
Correct.
So because now everyone's question on the Bitcoin side, naturally it will be whether is there going to be reserve, blah blah blah, stuff like that. I don't think he's going to make a big announcement. If he does, great, fantastic. I'll be very happy. But if he doesn't, I'm fine as well. But I think either way, you will be able to see a slow push of things, right? Now, on the other hand, I think there's another area that we want to take a look at is what are some of the policies that will be coming out that will affect the US dollar strength as well, right? I don't know. I feel like Trump is in this odd position. A lot of the policies that he talks about, like, for example, making US industry strong again, actually requires US dollar to reduce its strength, right? So that people can have more trade with them, right? But he also put himself in this weird position where another half side of his story required the US dollar to be strong. So he's a bit self-contradicting to a certain extent.
Which I think he loves it.
Yeah, it's like he's just trying to keep you on your toes, right?
Yeah.
It's like I tell you that this girl is pretty, this girl is also pretty. I don't know lah, like that. Then you go like, shucks, how am I going to make my decision moving ahead, right? Yeah. So just like a few weeks back, he made you think that he's going to go easier a bit. And then suddenly now he go hard. You don't know what's he going to announce next week. So I think it's a little bit of unpredictable.
That's what the people chose for, ma. They want it, ma. So we have to see it through in the next 4 years.
Yeah. So I think it's going to be a very volatile one. So for those of you who are investing in crypto, I want to say this one thing. I won't be surprised to see a drop of 40% any point of time. I just won't be surprised.
Yep.
Yeah.
Already 10% already.
Yeah. Now it's
30 more to go.
between 90 to 100, between 90 and 100.
Yeah.
That's what we are seeing,
Correct.
right? If it drops furthermore, maybe.
Yep.
I won't be surprised either. Yeah. So I think even if it is, well, I do believe that we are in the beginning of a bull market still, but I think it may be a very volatile bull market.
Yep.
Yeah, because we got a surprise Santa,
Yep.
Yeah.
I really don't know how crypto is going to perform because I read different kinds of articles and different articles give me different kind of answer. I've read articles that says that there's going to be a supply shock because apparently the Bitcoin ETFs that are buying that are buying Bitcoin last month outpaced the number of new Bitcoin that was being produced by a certain X multiple lah. So if there's a supply shock, then price is supposed to go up. But because of the past few days, market has been very jittery and all that. Apparently, there are also a lot of Bitcoin ETF investors selling their Bitcoin ETFs. So that gives even more pressure for the price to come down. So you see, I got no answer.
Yeah, it's both sides lah.
Yeah.
So I think in the short term, sentiment is going to be volatile. But
Correct.
on the only way is like we said earlier, you are not an institutional investor. You don't have to give report card. You just need to manage your own risk and deal with it, right? I think that definitely on a fundamental basis, we are seeing more countries or more institution putting crypto as part of their treasury, right? Then in terms of companies wise, I think it's just a matter of time that the cycle will go into value companies. Because I think right now, value the fundamental companies it's quite low priced,
Yeah. Because
especially in relative to.
yes, because nobody look at them.
Because if you look at them, you're gonna stick your damn neck out.
Yeah.
If you go and buy it, and that's not that counter, you're gonna mati, man. Who dares to push it?
Yep.
Who dares to push it? That's the problem. Oh.
Mm.
Yeah, and then as usual, because ETF is such a mammoth of a thing, again, it's a vicious cycle in itself. Right? Because you buy more ETF, they have to put more into it. You buy more ETF, you have to put more into the. So it kind of like self-perpetuating problem, right? Sometimes I think the financial system is a little bit flawed.
That's how it is.
There's another whole philosophical question later, right? Yeah. Okay. So, Frankie, anything else you want to add on before we call it a night?
Nope, I don't have any question.
All right. Fantastic. Now, maybe just one last one to ask you so that we can end the night with. What is your take? Is it time to sell our equity and ETF portfolio and buy gold, oil, commodities? Last question.
I've already diversified to all the things that you just mentioned. So I won't purposely go and sell off the shares just because the market is volatile. Because I already have gold, already have stocks and whatnot. But at this point, I'm not going to put in more money into those things. I'll just wait and see. Perhaps wait for President Trump to warm his chair enough already, then only see how we want to bring this forward. That's for me.
Yep. Myself personally, I've already readjusted my portfolio some time ago. So right now I'm just reaping the positions that I'm in. And I am in that position where I'm still dollar cost averaging into my investments. Yeah, so that's a position I'm taking. So I'm not really, say, intentionally diversifying into things at this point. Yeah. All right. So thank you very much, everyone. We look forward to see you again next week. If you like this particular episode, do hit the like and subscribe button. And if you're following us on Spotify, thank you very much. And if you want to hear us doing a more curated version, right, do send us maybe an email, right, mrmoney@mrmoneytv.com, or even, send us DM on our Instagram, right? We are thinking one of the things is that should we do a specific investment podcast?
Yes.
Then we do a more specific, general finance kind of podcast, right? So then at least we separate everything. Then people get a taste of different kind of stuff.
Correct.
Right? Yeah. So if you think that we should do that, we will try to gather at least 100 of y'all lah. Let's just put it this way lah. If there's 100 DMs. Yeah, I'm gonna make my team very angry if it's 100 DMs.
Every day have to check message.
Yeah. So if we have not say 100 DM now, maybe 100 email on mrmoney@mrmoneydv.com and tell us yes, we want more niche, more specific, like that. Then we will curate that. Yeah. So send us an email. If you get 100 of that, we're gonna put it into action. Yep. Thank you very much. See you next week.
All right. Good night, everybody.